it's difficult to evaluate a strategy just on 1 year performance. I think it needs to be viewed in context of both past and how well it hold up in the future. I think if you look at our returns over the last 10 years, we've been able to generate about 17% gross without very little correlation. So last year there was lots of opportunities. A lot of inefficiencies have been building for many years. So it was really, this is one of those situations where you're very confident that you'll ultimately be right, but difficult to know when. And a lot of the inefficiencies played out in 2015.
You're focused on energy exposures, and this has been a very difficult week for some of those energy companies, for the spot price on oil after talks in Doha amounted to no freeze on output. What was your take on the events in Doha?
Obviously, we monitor the oil prices or commodity markets very closely, but we are an equity fund. We invest in equities, so we actually try to seek to limit our exposure to commodities. So I would say there's a lot of volatility right now, but all that volatility also creates a lot of opportunities.
Is the volatility starting to go away a little bit in the oil market? I mean, we've seen the gyrations at the start of the year where some of the bear market participants were calling $10 on prices. We've well and truly lifted off that. So is the volatility going away at some pace?
I wouldn't say volatility is going away, but I think the markets tends to get a little bit too depressed at the bottoms and a little bit too excited at the peaks. I think most of our research goes into analyzing the supply cost curve. And even if we have, currently have excess production, inventory levels are very high, we believe that longer term, in order for production to be economic, oil prices need to go significantly higher. But it's a big question mark when and how quick that happens, and that's not an area where we're experts. We just try to exploit if individual equities are sort of discounting different oil prices.
What are the scenarios that you like in the oil market when you talk about equity exposures?
In the last 4 or 5 years, some of the inefficiencies that have been building are partly due to the cyclicality of oil prices and the traditional business cycles, partly due to all the fiscal and monetary policies that are being applied aggressively globally. And one of the things that we've seen that has been more structural is that a lot of companies have adopted dividend policies that are unsustainable and have been rewarded by the financial markets that don't sufficiently question the sustainability. And a lot of that unsustainable dividend has been financed by easy access to credit markets and equity markets. And last year, when the equity and credit markets shut down for a lot of these companies, I think it became pretty quickly evident that the dividends weren't sustainable. And investors realized a lot of the dividend that they've received in recent years has actually been return of capital rather than return on capital, and there wasn't much capital left. And I think that was a big theme for us that played out last year. But again, it's still in the early innings. I think there's plenty of opportunities out there yet.
Are you saying dividends have to be cut even further from here?
Well, for a lot of companies that have adopted policies that are unsustainable.